So one of the important aspects of issuing shares to public is to decide on the price of the share at which it is made available to the investors. And in this context, there are different pricing methods. The first one being the fixed price method. The second one being differential pricing method. And the third one is the book building method. So last week we were discussing all these three methods. So let me just quickly recall. In fixed price method, the price is predetermined by the merchant banker in consultation with the company, and the price is printed in the prospectus. So the investors are well aware of what the price would be. And in case of differential pricing, usually the share is issued at a discounted price for retail investors and for employees. However, there is no discount for other categories of investors. So that's the reason it is called differential pricing, because there are two different pricing here. One for employees and retail investors, usually a 10% discount. And then for other categories of investor, there is another price without discount. So that's the reason it is called differential pricing. And the third and the most widely used method of pricing, especially this method, is mandatory in case if the company does not meet the SEBI criterias, which we were discussing in the last class. If company does not meet all the five criterias of SEBI or any one of those criterias, right, then the company has to go for a book building offer method of pricing. So what happens in book building method of pricing is that you don't identify a straight price, but rather you identify a price range. So what the merchant bankers will do is the merchant bankers will identify a price band. Usually it is called a price band in consultation with the company and based on their analysis. Now, after the price band is identified, the price band is not printed in the prospectus, in fact. And the prospectus which has pricing information missing in it, it is called draft red herring prospectus. So usually in case of book building method, it is draft red herring prospectus because it is not mentioned in the prospectus as to what price it is. The price is decided at a later point in time, and then it is communicated to the public through an advertisement. So an advertisement is given to communicate what the price band is. Now this price band is the option at which public can bid, whether they want to bid at a lower end of the price band or whether they want to bid at a higher end of the price band. That is decided by the public. So usually public will bid at a higher end of the price band because the chances of getting is much better. And in case of demand is very high, then definitely you should bid for a higher end of the price band. So the lower end of the price band is called cap price, floor price, sorry, and the higher end of the price band is called cap price. So let's say a company is issuing shares and it has come up with a price band of 125 to 140 rupees. That's a price band given to the investors. Now investors have to decide whether they want to bid at 145 or whether it is at 150, right? But do keep in mind, investors do not have an option to bid either below the floor price or above the cap price. They have to bid either at floor price or at cap price. These are the options given to them. So therefore, in case if the demand for IPO is very high, there are too many investors who are applying, then definitely it's more ideal to apply at the higher end of the price band, which is at the cap price. Now, once the bids are collected, once the bids are collected, usually in olden days, we used to have a form. So if you're interested to apply for IPO, you need to fill up this form mention your bidding price, and then submit this form to a designated location, right? And investors, all the forms submitted by the investors, various categories of investors. First, it will be subdivided. How many categories under retail investors? How many categories under high net worth individuals? How many applications under qualified institutional buyers? So first segregation used to be done by the book running lead managers. They're also known as BRLM. Now, once this segregation was done, they would enter the application number in a register. Next to the application number, they would enter the bid price, so at what price the investor has quoted. And during this process, if there are 1 lakh applications received, or let's say there are 10 lakh applications received by the company, imagine 10 lakh application numbers you have to write, and the bid price of 10 lakh application has to be entered in the registrar. So that's the reason this person, the merchant bankers who are engaged in this process, were also called as book running lead managers. And this method of pricing was called as book building. So what is this book building? Because obviously the books are getting built up by the number of registration numbers and the bid prices. But now, you don't have any register system. Everything is automated, but still the name remains as it is, book building. The books are getting built by the number of entries. The more the application, the more books you need. So the book running lead managers need to run more and more books, right? So that's how it used to be. And that's how this name book building came into picture. Now, the final price at which everybody will get shares, either at floor or at cap, it will be decided by the merchant banker. That price is called as cutoff price. So cutoff price is the price at which the shares will be allotted to the investors. Then you have lot size. Lot size means minimum quantity of shares included in a lot. So investors has to either buy a lot or in multiples of lot. In primary market, you cannot buy 1 share, 2 shares, 3 shares like this. Yes, of course, in secondary or the stock market, you can buy even 1 share also. But when you're buying it directly from the company, when the shares are being issued, also known as primary market, you cannot buy 1 or 2 shares. You have to buy in lots. So how many shares will be there in each lot? That is also decided by the merchant bankers. It varies from company to company. It is not standard. So some companies who share this price at a very higher end. Let's say 1 share itself is 5,000. Then probably they'll keep the lot size small so that even smaller investors can invest in the company. So let's say 1 lot is equal to 5 shares. But if the price of the shares are very cheap, very low, let's say 1 share is like 50 or 60 rupees, then what will happen? The lot size will become higher. So 1 lot is equal to 100 shares. So let's say if you want to buy more than 100 share, what you have to do? You cannot buy 101, 102 shares. You have to buy in multiples of lot, which means either buy minimum lot of 100 shares or in multiples of that. So next what you can bid for is 2 lots. 2 lots means 200 shares. 3 lots. 3 lots means 300 shares, like this. So lot size means minimum number of shares included in the lot. Then you have the tick size. Tick size is nothing but uh, cap price multiplied with the lot size, right? So price multiplied with specified uh, price band multiplied with lot size. So that's what you call as tick size. So let's say if the price is 100 rupees, if the lot size is 1 lot is 100 shares, then 100 rupees into 100 shares. So it will become 10,000. So 10,000 is the tick size. Right, so that's how it works. Then cutoff price, as I mentioned, the rate at which the shares get allotted, they are called cutoff price. Right, so this is how the process works in book building: appointment of book runner or the book running lead manager, selection of price band, applicants then bid for the shares. The syndicate members are hired to obtain bids from the investors. So investors have to mention their bids in the share application, which is online these days. You don't have to fill up any form. You can apply online using a website or a mobile application. So normally, whenever a company comes up with an IPO, the issue is open for 3 days, 3 business days, right? But in case if a company gets a very poor response, people, not many have applied um, for various reasons, then in that case, the company has the option to make changes in the prices and then extend the IPO by another 10 days, right? So the final price decided at which the shares are issued, it is called cutoff price. So this is how the entire process of book building works. Right now, in the past, many IPOs have been withdrawn, but not many cases are there like this. But there are instances where IPOs were withdrawn. The reason why IPOs were withdrawn because these IPOs did not get adequate subscription and therefore it has to be cancelled, right? So there are possibilities such things may happen, but in case if such thing happens wherein you don't have the buyers for your company shares, what is the solution? Can something be done about this? The answer is yes, there is a solution for this, which we will discuss little later. But the point here is that you should remember in case if company shares are not being sold, there are no buyers, the demand is very bad. The company has always an option to reduce the price and again to relaunch the IPO and extend it by another 10 days. So that option is always there. Now let's do a comparison between what we were discussing, that is book building method of price discovery and fixed pricing method. What's the difference? The difference, as I told you, in case of fixed pricing method, the price is predetermined and it is printed in the prospectus. Investor already has knowledge about the pricing from day one. Whereas in case of book building method, the price is not mentioned in the prospectus. It is decided later and communicated to the investor via advertisement. And in case of book building method, you don't have a one final price, but you have a price band in which investors have to bid and decide at what price they want to bid, whether they want to bid at floor price or cap price. Now, another interesting point to note down here is that in case of fixed pricing method, demand for the issue is only revealed after the closure of issue, which means if the issue is open for 3 business days, so let's say at the end of 3 business days in fixed pricing method, the merchant bankers will release data, how many shares were issued, how many number of applications were received. So let's say if I have issued 1 lakh shares, if I have received 80,000 application, which means there is an undersubscription, right? In case of I am issuing 100 shares and 100 people have applied, it's good because all the shares are subscribed. If I'm issuing 100 shares, but 1,000 people have applied, then this is called oversubscription. Now, oversubscription is an indication that there is a great demand for the company shares. And the moment the share is listed on the stock exchange, people will throng to buy it from the stock exchange. And immediately the prices will further shoot up, which means the investor would have bought it directly from the company would now get to make a lot of profits, right? So what happens here is that in case of book building issue, the demand is disclosed on a daily basis. As I mentioned that the IPO is open for 3 business days. So at the end of first business day in book building method, the merchant banker will release the data in the media that on day one, how many percentage of shares are being subscribed. So let's say if we are issuing 100 shares on day one, 10 shares were bought, which means only 10% subscription is filled. Another 90% is empty. On day two, right, out of 100 shares, let's say 50 shares are subscribed, which means at the end of day two, 50% subscription is there. So what will happen is by looking at the subscription percentage on day one and day two, you can easily estimate the demand, how the demand would be for company shares. And the moment it hits stock markets, how it is, I mean, whether it is possible that the prices will shoot up or not, you will get an idea. Whereas that idea you will definitely not get in fixed pricing method because in fixed pricing method, the subscription data is revealed only after the closure of the issue. But here during the issue itself, on a daily basis, the merchant bankers are releasing data. Day one, how many percentage of shares are subscribed? Day two, how many percentage of shares are subscribed? So on a daily basis, you're getting some information which you can utilize to buy these company shares and to, in case if you get them, then you will become lucky, because if the demand is more, the prices will definitely go up. Now the reservation system is also different. In fixed pricing method, the reservation system is 50% of the shares are offered and reserved for applicants below 1 lakh, and the balance is for the applicants which is above 1 lakh. So in this, there are only two categories of investors. Investors who would have applied for shares value which is less than 1 lakh and more than 1 lakh. Whereas in book building, the reservation is slightly different. 50% for qualified institutional buyers, 35% for retail investors, and 15% for your high net worth individuals. So these are some of the differences between these two methods of pricing. Fixed method pricing, it's totally different from book building pricing method. So these are the two widely used, but the most popular one is book building method of pricing. Now, one question which I did ask you, what if the shares are not subscribed? If the shares are not subscribed, then obviously company has to withdraw its IPO, cancel its IPO, and return the money to the public. Because if a company wants to issue 100 shares and if only 20 people have applied, then what will the company will do with those 20%? Company's objective of borrowing funds will not be met with the kind of money what it is getting from less subscribers. So obviously, SEBI says, okay, return the money. In case if you're not getting adequate subscription, it means people don't have trust in your company, and therefore return the money to the shareholders. But SEBI has also, to benefit the company, has made little uh, liberal reforms here. Now, under what circumstances it will be considered as under subscription, which leads to cancellation of the IPO? So the answer to this question is 90%. Whenever a company comes up with an IPO, at least it should get 90% subscription. But in case if the subscription amount is less than 90%, then the company can't go ahead with IPO. IPO would be cancelled. So at least minimum subscription is what a company has to focus on, right? At least 90%. If it is able to get 90%, then it's the 10% can be adjusted. Now, how the 10% will be adjusted? That is the question. How that 10% will be adjusted? Because recently, Star Health, which is one of the renowned life insurance companies in India, even they had come up with an IPO, and unfortunately, they did not get the numbers. Right? You know what happened in their case? The QIB quota, qualified institutional buyers, uh, they got it only, I mean, somehow they were able to fill it, but some of the other quotas they were not able to fill it. So they had total only 79% subscription, somewhere around 79-80. So they had to face this challenge. They had to find this difficulty of fulfilling the minimum requirement of 90%. If the company is able to get 90%, then the 10% can be adjusted with the help of an institution called underwriters. Now, underwriters, what they do is underwriters are basically institutions. They are financial institutions like your banks or non-banking financial corporation. So what they do is they underwrite, which means they give it to you in writing in a contract that in case if you don't get 100% subscription, we will buy that remaining quota, which is not being purchased by the investors in the market. So let's say 90% somehow we are able to sell to the investors, but remaining 10% of your shares could not be subscribed. People did not apply. So that 10% you can sell it to underwriter. So underwriter, before the issue is open to public only, will enter into an agreement stating that if people don't buy, the minimum percentage of 10, I will buy it. Right? So this is how underwriting agreement works. So underwriting of share, is it compulsory that every company which is going for public issue should go for underwriting? The answer is underwriting under the law, the company has to refund the investors if their money, if their subscription is not up to 90%, and it has to be refunded by 15 days, right? So that's how underwriting, that's what underwriting norm says. Whether underwriting is compulsory or not, it purely depends on the company. If the company has already entered into an agreement of underwriting before it could issue the shares, there are two ways. You can either enter into an underwriting agreement before you have issued the shares, before the issue is open. If you enter into an agreement before issuing the shares itself, it is called hard underwriting. But if you enter into an agreement with an underwriter after you realize that unfortunately we're not able to get that 90%, then it is called soft underwriting. Right? So either you can go for hard underwriting or either you can go for soft underwriting. So both the options are available. So what these underwriters will do is basically they will end up buying all those shares which you were not able to sell to the public. And as I mentioned, it cannot exceed a minimum of 10%. Only 10% of the shares can be underwritten, not beyond that. And underwriting comes into picture only when if a company has sold 90% of its shares, but for 10% it is stuck. Right? In that case, the company can go for underwriters. Underwriters will agree to buy those shares. At what price underwriters will agree to buy those shares? Will the price be same as what is being kept for the other investors? It depends. It all depends on the underwriting agreement. Sometimes underwriters would definitely want to, you know, buy your shares which are not subscribed, but at a discounted price, not the same price what you're giving it to the general public. So it all depends on the underwriting agreement. Sometimes the underwriters agree to buy the shares at a discounted price. Sometimes they agree to buy at market price. So it all depends on the underwriting agreement. So this is how underwriting works. So in simple words, who is an underwriter? Underwriter is a financial institution who undertakes to buy unsubscribed shares during the IPO process. So for doing this job, what underwriter gets? Answer is he will get two things. One, he will get those shares which unfortunately public could not buy them. And second, they will also get commission. So they get commission also. So for underwriting, they are given a commission which is also decided by the SEBI. So SEBI decides how much underwriting application can be given maximum. It can be less than this, but it cannot be more than this as per the provisions of SEBI. Right. So this is what underwriting is all about. So these are the commissions. So it varies depending on the amount, depending on the what you're issuing. So this is how underwriting works. But sometimes, if the amount of underwriting involves huge money, let's say your one share is like 4,000, 5,000, and 10% of the shares are not being subscribed. So one underwriter might not be able to buy all those shares or underwrite all those shares for especially big issues. So in such case, a company can go for syndicate underwriting. So in syndicate underwriting, what happens? There are multiple underwriters. There are not one, but there are more than two underwriters who jointly agree to go for underwriting agreement. Then you have sub underwriting. So what will happen in this sub underwriting? The main underwriter, he will personally enter into an agreement with another underwriter, saying that in case if the share does not get subscribed, you have to buy from me a certain percentage of shares. So this is called sub underwriting. The normal underwriting is called firm underwriting. So you have firm underwriting in which the underwriters will agree to buy the shares which are unsubscribed by the public. Then you have sub underwriting in which the main underwriter will enter into an agreement with another underwriter saying that you buy so many percentage of shares from me in case if there is any under subscription. Then you have syndicate underwriting, in which you have multiple underwriters jointly entering into an underwriting agreement, right? So this is how it works. In underwriting, there is one more very interesting clause called green shoe option. So let's discuss what is this green shoe option. See, underwriters come into picture only when there is an undersubscription, which means a company has issued a certain number of shares, but unfortunately, all those shares were not purchased by the investors. SEBI says underwriters come into picture only if there is 90% of subscription. Below that, you have to refund the money to the public. So let's say there is a company called Company X. Okay. So this Company X is issuing 100 shares. Out of 100, 92 are purchased by public. So remaining 8% is left out. So now the company can approach underwriters to buy that remaining unsold shares, right? But let's say a company has issued 100 shares, but only 78 people have bought those. Remaining 22 is unsold. In that case, even underwriting will not help you. You have to cancel your IPO, refund the money of the investors. Okay. But let's say option number 3, a company has issued 100 shares, 10,000 people have applied. In this case, you don't even need underwriters, actually, technically speaking. But let's say as a precautionary measure, you had already entered into an agreement. You have already uh, entered into an agreement, and now you don't need an underwriter because you're in a very good situation. So in this case, what underwriters will get? Underwriters will get their commission because they agreed in the beginning itself to do underwriting in case if there is any risk in the future. But now there is no risk because you have 10,000 application for just 100 shares. So underwriters, we don't need them, right? So what happens in this so-called green shoe option is underwriters will get benefited, and underwriters will come into picture not only just during the under subscription, but during over subscription also underwriters get benefited. Now, how is that? Now, as per the green shoe option is one of the options in the underwriting agreement. So what this green shoe option says is in case if there is oversubscription, in case if at all more number of applications have come than the number of shares which are being issued, in case if such situation arises, then the green shoe option clause will be implemented. So green shoe option means an option for allocating shares in excess of shares included in the public issue. So there is an arrangement wherein the issue would be over allotted to an extent of maximum 15% of the issue size. What it means is you are a company, you are issuing 100 shares. But in case if you get oversubscription, let's say for 100 shares, 10,000 people have applied, 10,000 applications have come. So in this case, in green shoe option, to accommodate this huge demand, you have to give additional some shares, not beyond 15% to the underwriter. So let's say if 100 shares you are issuing, 10,000 people have applied, right? Now underwriter will have no role to play in this. But in green shoe option, what it says is that in case if there is oversubscription, you give 15% extra shares to the underwriter, not to the public, but to the underwriter. Now, what will happen? Underwriter will buy this 15% shares. He will sell them at a very high price because the demand is already on the higher side. So he gets to make a lot of money because of the huge demand. So underwriter will get benefited even during oversubscription because in oversubscription we generally don't need underwriters. But green shoe options helps underwriters to make money during both. During oversubscription. In undersubscription, they suffer loss, but in oversubscription, they have to make profit, for which they are given this option called green shoe option. And in a way, green shoe option also helps because the moment the demand is very high, the prices will shoot up. So in order to stabilize that price, right, to make the price little calm, when you give additional supply, automatically the price will also come down. So sometimes this green shoe option also help companies to stabilize the price in the market, right? Something which investors might not like, but Yes, price stability comes when you show additional supply of shares. So this is how green shoe option works. So in simple words, green shoe option is an option in which an issuing company agrees to issue 15% extra shares in case of oversubscription. And this 15% extra shares are not given to public, but they are given to the underwriter. So underwriter gets to make good money during oversubscription also. Now the question is why it is called green shoe. First of all, why it is called green shoe looks very weird. I mean, what's the logic behind calling this as a green shoe option? Now, the reason why this is called green shoe option because it was first introduced by a US company called Green Shoe Corporation. So the option of green shoe was first given by a shoe company called Green Shoe Corporation, and that's how the name came green shoe option because of the company which introduced this option for the first time. Now, these are the leading merchant bankers, Goldman Sachs, Morgan Stanley, Merrill Lynch. They are globally renowned merchant banking organizations. What are the benefits of underwriting? In case if underwriting does not exist, what kind of trauma the company has to go through. But luckily, there's underwriting which helps a lot of people, a lot of companies, right, in borrowing the kind of money what they are willing to for their business purposes. So underwriting definitely helps issuing companies by fulfilling the gap. So first benefit is that the companies are relieved from the tension of marketing of securities and of uncertainties in the market. So marketing of securities is undertaken by the underwriters themselves. Fulfilling statutory regulation of minimum subscription. If underwriting does not exist, then most of the companies would have failed to meet the minimum criteria, right? So because of underwriting, it is possible now for company to meet the minimum requirement of 100% uh, right issue of shares. Uh, it also helps the company some sort of a peace of mind. The company gets at the back that, okay, in case if there is under subscription also, underwriters will help me. So that peace of mind is guaranteed. So company may not get deprived of funding and capital, right? So guarantee of adequacy of capital and helps companies in some sort of a having peace of mind. Quick sale of securities. If underwriters are there, obviously public will also come forward to buy the shares because the issue is backed by the underwriters. But there are certain disadvantages also. First of all, it's very costly because you as a company, you have to end up paying huge amount of commissions to this underwriters, right? So that's a drawback. Second, you have to share all your business information with the underwriters. Underwriters will not just blindly write your shares just like that. He will also consider what is the kind of experience you have, right? And in order to convince the underwriter, you have to share all the information about your company, both financial and non-financial. Only then a merchant banker or the issuing company can also decide whether to only if you give proper information, only if you disclose all your financial and non-financial information, the underwriters will decide whether to underwrite or not. But in order to do so, in order to convince underwriters, you have ended up disclosing all your financial and non-financial and also sometimes secret information. Right. And sometimes the more number of shares you issue to the outsider, the insiders, especially the promoters, are losing control over the company. The more number of shareholders you issue to public, the lesser the control you have as a promoter in your own company. So these are some of the pitfalls or drawbacks of underwriting. Now, in the entire process of issuing shares in the primary market, there are different entities involved. And all these entities have significant role to play, right? So first we have merchant banker, who's the most important entity, who's part of the entire issue management. Then one more we just discussed, underwriter. Underwriter also has an important role to play in fulfilling that uh, minimum subscription clause. And then you have some of the other entities. The third entity here is bankers to issue. Now, who will collect the money from public and give it to the company? That's the question. The answer is banks, bankers to issue. So the issuing company will enter into an agreement with the management or the merchant banker saying that you are responsible for collecting funds and maintaining the funds. So banker to issue is responsible on behalf of the issuing company to collect the money from the investors and keep it in the reserve till the finalization is done. So all that money which is collected is kept in a separate account called escrow account. It's a dedicated account where all the money, share application money, is kept. So don't be under the impression that the moment you apply for the share, the money directly goes to company's account. No, the money will remain with bankers to issue. So they will safeguard your money. The money is not directly given to the company. After the shares are issued, what merchant banker will do is from the escrow account, the money is transferred to the company's account only after the shares are issued. Right. So SEBI has come up with such measures to ensure that there is no fraudulent activities. Right. So now these days we have another new option called ASB, application supported by blocked amount. Earlier, what used to happen was investors who wanted to apply for shares had a tough time because as I told you, olden days we had first of all paper application. So that application you have to fill up, right? How many shares you want at what price. Once you complete the application form, you have to go and deposit that application form with the bankers. So who are the bankers of the issuing company? That will be mentioned in the prospectus, right? After applying for shares, that means after depositing my money, in case if I don't get the shares, because in case of oversubscription, there is possibility that you might not get the shares. Not everybody will get the shares. In such case, the money has to be refunded. But the problem was, in order to refund this money, earlier bankers used to take a lot of time because earlier the money was directly given to the company. The moment somebody applies for shares, that money used to be handled and managed by the company. Company used to keep all that money. So imagine company used to earn a lot of interest also in a short period of time, because by the time you collect money, by the time you issue shares, this itself used to take 3 months, 4 months. So there are thousands of investors who have applied, but they are not getting shares. But still their money is stuck with the company and company is taking its own sweet time to refund. So in order to avoid this problem and inconvenience, SEBI came up with a new concept called application supported by blocked amount. So what happens in this concept called application supported by blocked amount? Your money will not be withdrawn from your account at all. Let's say I'm logging into my account and applying for shares of company ABC worth 10,000. After applying for those shares, the 10,000 will be frozen in my account. The money will remain, but I will not be able to use that money for anything else. Let's say after issuing shares, I get the shares luckily. In that case, the money will be deducted from my account and the money will be transferred to the bankers to issue and they will keep it in the escrow account. But let's say, unfortunately, I didn't get the share. In case if I don't get the share, the amount in my account will be unfreezed. So the money is with you only, technically. You're not giving the money to the issuing company, right? So it won't take a land like earlier days. It used to take 3 months to get the refund, but it's not now. Now there's no question of refund at all because only the money is freezed in your account when you apply. And in case if you get shares, the money is deducted. If you don't get shares, the money is unfreezed. So this method of issuing is called application supported by blocked amount. And once all that money is collected from the investors, that money is kept in the escrow account. And once all the shares are issued, all the grievances are addressed, the banker to issue will transfer the money from the escrow account to the company's account. Now the companies can use that amount for the purposes what they have identified in their prospectus. So this is how the This is what bankers to issue do. Now you also have registrar. Registrar is a record keeping authority. So registrar basically is an organization that maintains the records, because lakhs of people would have applied. In that, few lakhs would have got the shares. So registrar should know all these details. So registrar is basically a record keeper. Now, what are the things that registrar does? Application management, determining the basis of allotment, finalizing the allotment of securities, processing of refunds. So all this clerical and administrative work is done by the registrar to issue. Now the question is, how do you decide first of all who will get shares and who will not get shares? Now before you could do that, you have to follow certain things. First, you have to do segregation. Okay, I have issued 100 shares. In that, 50% reservation is given to qualified institutional buyers. 35% reservation is given to retail investors. 15% reservation is given to high net worth individual. So in each category, how many applications you have received, that needs to be separated and segregated. So that's the first step. Now, once you have done segregation, separation, right? Separation is done. Now, finally, you have to figure out what is your oversubscription ratio, if there is any. If you have issued 100 shares, and in case if 100 people have applied, then you don't have any tension as a merchant banker, as a registrar, because everybody will get shares, right? But the problem arises only when there is oversubscription. If you have issued 100 shares, 10,000 people have applied, how will you decide who will get shares and who will not get the shares? On what basis? So the answer to this question is that it is decided by the merchant banker, either by using proportional allotment method or lottery method. So you should learn now how this proportional allotment method and lottery allotment method works. And remember, these two methods comes into picture only when there is oversubscription, and when there is number of application and number of shares, when both are equal, then it is called firm allotment. You don't have any tension in that case. Everybody will get shares, but the problem arises only when there is an oversubscription. So when there is an oversubscription, what will happen? The registrar will either use proportional allotment method or lottery allotment method. So let's see how these two methods works with the help of an example. So this is the example. A company is issuing 1,000 shares, okay? But 3,000 people have applied. So first thing you need to do is find out what is the oversubscription ratio. So the oversubscription ratio, 3,000 divided by 1,000 is 3 times. The oversubscription ratio is 3, which means for every 1 share, 3 people have applied. Oversubscription ratio is 3. And then what is the lot size? What is the minimum shares you want to sell? In this example, it is 30. So if you want to more than 30, then you have to apply 60, 90, 120, 150, 180, 210, either minimum or in multiples of lot, either minimum lot or in multiples of lot. So here are the situations. Situation number 1, Mr. X applies for 2 lots, which means he has applied for 60 shares. How many shares he will get? Because the company has oversubscription. So the answer is, I will divide the number of shares applied by the shareholder with the oversubscription ratio. So 60 divided by 30, that means this investor is entitled to get 20 shares. But unfortunately, he will not get the 20 because we can issue only minimum lot of 30. So his application is kept aside because he may not get it, right? But let's say next investors, he has applied 4 lots, 120 shares. So 120 divided by oversubscription ratio. So he is entitled to get 40. But a company, as per the rules, it has to issue either in lot or in multiples of lot, which means this guy will end up getting at least 30 shares. So this is how proportional allotment is done. And in case if at the end some odd shares are left out, those odd shares are again allotted using lottery method, using the lottery method. So this is how the allotment of shares are done. Once the shares are allotted, what will happen? Investors will get those shares, right? And it's if there is a good demand, the prices are if there is a good demand, then you can anticipate the prices will go up in the stock market the moment the share is listed. Now, what do you mean by listing? After allotment, the next step is listing. Listing is a process of making the shares available on recognized stock exchanges for public trading. So the moment the share gets listed, it means now you can buy and sell them on a specific stock exchange. But in case if you're not listing, then you cannot buy and sell. So listing is mandatory. So you have to list the shares. So once the shares are listed, it's a proud moment. Listing of share, usually what will happen, the CEO of the company will ring the bell, and the moment the bell is rang, the trading will start. So it's all a very important historic moment in the uh, journey of the company from becoming a private to a public company and getting listed on renowned stock exchanges across the globe. So this is how the listing process works. Listing means the share is now available publicly for the purpose of buying and selling. Now, usually, if the company has issued share for 100 rupees, then the price should also get listed at 100 rupees. But unfortunately, but actually that does not happen, right? If the company is issuing shares at 200 rupees, the listing price becomes more than that. So the question is, how does this happen? If a company has issued share at 100, how does the share gets listed at a price which is more than the issuing price? Who decides the listing price first of all? The answer is the listing price is decided during the bidding process. So even before the shares are available for trading to public, there is a bidding that take place between 9 to 9:45. So 9 to 9:45, all the bidders, all the stockbrokers will bid for the price. Some sort of an auction happens, and the average price during the auction is decided as the listing price. So let's say if a 100 rupees share gets listed for 210 rupees, that means the investor has made a listing gain of 110 per share. So the listing price is decided during the auction, which happens between 9 to 9:45 in the stock exchange. So in case if the demand is very high for a company shares, then obviously the brokers will bid the shares at a higher price, and then that's how the price shoots up. So that's the difference between listing price and the issue price, right? And sometimes, the listing price can also fall. The company would have issued share for 2000, but if the brokers feel it's not worth, then they will bid for a lesser price, and the listing price would obviously be less than what the company had issued. So this is how the listing is done. So this entire process is called as the issue mechanism. So this concludes your entire process of issuing the shares. So any questions you have in the concepts what we have discussed in today's session?